Now, as we continue into segment 2, we always start off with looking at what is the average of things that are happening in the market. Where are things going in terms of those averages? And we finally had that bounce. Last week we're at 13.151. Now we're back to 15.42. But again, that spike back up will fade. And we're going to be at around that 14.3, 14.5 level. 13.1, way too low. That is not something that is sustainable. But it's again, that ebb and flow, which is why we look so much at the 4-week rolling average and how we are going to continue to trend closer towards the 14 million barrel a day number. But again, 14.2, 14.3 is, I think, a very comfortable number. Maybe, move back up, especially as we come towards that diesel consumption side, back to about that 14.5 level. But we always have that slowdown as we come into October, and then where that flatlining and then starting to creep back up as we progress through November. But the progress in November is always going to be dictated based on how cold did it get and how quickly. If we have a warm October, warm start to November, that will obviously put some pressure on where that demand is going to be on the heating oil side. So then when we look at distillate here, you can see 2.89 million below the 5-year. That's a total, a draw of 2.89 million. The 5-year average is 28.6 million below the average. And most of that still is driven by pad 1 of a drop of 20.2. And then pad 2, a drop of 5.9 million below the 5-year. So again, you have about 26 million barrels a day of the shortfall really held between pad 1 and pad 2. Now that you've lost BP's Toledo, now that you have the winter coming through, and there is a decent amount of heating oil that is consumed in the Midwest, that is consumed in the North, and that's going to weigh in terms of where some of the pricing is, which is where you're going to continue to see some of that pressure on just the amount of distillate in storage and what that pricing looks like. Imports were down slightly, 13,000 barrels a day, driven by pad 1 with a drop of 18,000 barrels a day. As we get more of that Chinese product kind of unlocked, that's going to flow into Asia. More of that product is going to be displaced and again move into Fujairah and then really kind of settle and get absorbed into the Atlantic basin between both Europe and the US, which is what we've been talking about. But now you're seeing it reverberate back in both Singapore data and Fujairah data, which we're going to talk about in the next segment. When you look at distillate fuel oil and pad 1, you get this really defines just how broad of a shortfall we have. We should be building. We're not. We're just going sideways. This is going to continue to be a massive overhang and, again, lead to that pricing support that we've talked about, especially as we get into the heating oil months. Distillate, you could see we're just above, or we should say right at 2021 levels. They're fairly normal when you look at where the aggregate is. There was obviously been some outlier years. There's been about 4 of them, obviously 2020 being the biggest. But there's still this opportunity, which is why when you look at exports have actually increased a decent amount into Europe. Because when you look at storage in pad 3, fairly normal, fairly comfortable. So there is a decent amount of opportunity to get this product into Europe. And just based on pricing, this is where we're going to continue to see. It's just going to be a management of how much of this product goes from pad 3 into Europe. And as the Gulf of Mexico feeds into Europe, and as that additional Asian cargoes, Middle Eastern cargoes make their way into the Atlantic Basin, it will open up some of that opportunity to come into pad 1, because pad 3 will feed into Europe. Asia, Middle East will feed into the Atlantic Basin, with some of that being absorbed into the East Coast. And which is also going to drive up prices for the East Coast and for the consumer, because remember, the Jones Act is there. The Jones Act makes it a bit more prohibitive to export from Houston into both Boston, New York Harbor, just because you need a Jones Act flagged vessel to make that movement, which are expensive, which is why PADD 3, just given where prices are in Europe, they would rather just export it without issue going into the European markets, but that'll take away some of that demand and again, pull some of that into the some of that new product into the U.S. So when you look at supply demand here, you can see that we had that drop kind of pretty close to seasonal norms. Now we're back up. We've now had that again overextended to the downside, overextended to the upside. We just expected to be just below the 5-year average, the bottom end, the lower end of the cloud. Nothing too crazy one way or the other. We do see way more pressure coming into the shipping world. The slowdown in the economy is biting hard. We're seeing that slowdown on what is coming to the coast, what is moving through the U.S. And unfortunately, now is typically the time that you see a ramp because we're coming into the holiday season and we're just not seeing it, which is going to keep diesel demand fairly diminished. Now, on those lines, we obviously still have trucking demand that is a bit more elevated versus previous, but it's back to a fairly comfortable number of 57, 56. But we do see more downside trending as we progress into October and November, just as you have that reverberating piece where inventories are catching back up, the supply chain is normalizing a bit, and we have that slowdown of the cargoes coming into the U.S. and how that's getting passed on. We do have more activity on the rail side, which is also taking things off of the roadways, and that's going to put more pressure to the downside on the trucking front. Now, when you look at obviously coming into the U.S., you can see every single week is at least 21 to 42% below the previous year, which again is just showing where the pressure is, how we have that slowdown coming through, and that's going to reverberate through the system. And just given where demand is, how demand sits, we don't see that changing just based on the pressure on the economic front. Now, when you look at temperatures are fairly normal to below normal in PADD 1, and then slightly cooler in the Northeast. So not too much to say one way or the other. We're still in that. Maybe the heat kicks on in the overnight. We don't see anything too crazy versus normal. And then you have some of that heat that is residual, essentially from the Mississippi River all the way out to the West Coast. You're above normal, but just based on timing, it just means that you're not using AC, you're not using heat, so that'll put a little bit of pressure on that gas, but hopefully open up some opportunity to build up some of that heating oil storage. But just based on the levels that we're at, especially in PADD 2, you're not really going to be able to get that. And we still see, again, nothing in the temperature world that is showing that we're going to be in a better position anytime soon. Gasoline had a drop of 2.42 million. That was driven by PADD 1 with a drop of 1.26 million. And again, that's very normal given the events that have happened with the hurricane. You'll see more of that move through. Again, as they try to make sure that there is enough available. When you look at just where there's builds, so PADD 3 is still 2 million above the 5-year average. We just see it being fairly fixed here. We should start to see some builds. And the reason why we'll start to see some build is because gasoline demand is still below what is normal, or at least a 5-year average. And you will have, again, refiners that are going to try to target that distillate cut and inherently throw off gasoline. And there's still a global gasoline glut, and there's spare capacity for storage in the U.S. So there's still a significant amount of gasoline within Europe. So imports dropped 250,000 barrels a day. PADD 1 dropped 162,000 barrels a day, which is typically what happens as you start to see that a hurricane come through. A lot of cargoes will avoid, especially where it is. You have A, B, and C. B and C was completely avoided. They try to get as much as they could, and then they avoid. And then as the hurricane passes, these ships will come back. So we will see imports increase. Then it's typically a timing delay. We expect it to be right around the 5-year average. We don't see a huge shift higher right now. There is more in Europe, but when you look at the European U.S. spread, it had opened on the diesel front, but still remained fairly tight on the gasoline side, and it's actually starting to open back up. So then as that opens back up, that will bring some of those flows. Because when you look at the gasoline front, because of BP Toledo, that going down, that has now pushed pricing back up just based on availability of product. When you look at Pad 2 is 6.1 million barrels below the 5-year. So you're going to get some of that pricing ability in terms of coming into both Pad 1 and then trying to pass it off to Pad 2. And then if you look at Pad 3, trying to get that up into the Midwest, there really isn't much pipe capacity to do it because the Colonial Pipeline runs the coast. So a lot of that will be done by rail to try to take advantage of some of that pricing. When you look at total inventories, you get an idea of, it's clustering right in that piece. We do expect to see some of those increases. It's moved down with seasonality. We do expect to see that move back up, obviously, as the hurricane passes and things normalize a bit. On the demand side, you can see that China is still remaining elevated. There was a lot of rumors about Xi, and we'll talk about that next week, because we've always highlighted how there is a lot of Xi doesn't have complete control, and he has to manage relationships because there are people within the party and within the country that don't like his standings, his views. In Shandong, Guangdong, different parts of Shanghai, Beijing. So again, there's always that balance that has to be run. So, but people, I think, discount that, and you had some of those rumors kicking back up. But again, it's not that anything actually happened. But I just think that people were a bit more shocked that he doesn't have complete control, that there is some of that discord. And when you look at the issues on the economic side, the issues on lockdowns, it's kind of easy to see. On the Google mobility side, you can see that it's starting to slow back down. That's typically normal for this time of year. Europe rolled, America rolled. We do see more pressure on the Asia Pacific side, but again, we've been saying that and still holding in fairly tightly. It's just a matter of, as the world continues to struggle on a pricing basis, how much of that will come down. TomTom saw Europe had a nice little spike. North America is rolling back over, but again, not by much. It's just you get a little bit of that bump for the holiday weekend. You also had a lot of movement because of the hurricane, people moving out of its path. So this is, this will come back down and be fairly normal. Gasoline prices started to edge back up. Again, a lot of that was due to the disruptions we've talked about. We see it creeping a little bit higher, not getting to obviously where it was. And then when you look at diesel is now at $4.88, and you can see the broad disconnect between diesel and gasoline, and that will continue. Diesel's going to continue to be in a very bullish pricing environment, so we do not see that changing. On the blending side, we're right at 2017 levels, moving down with, again, that seasonality. We do see a little bit of a stabilization and that creep back up. But as you can see, it's very normal versus the seasonality side. So a movement back higher is just going to be in line with what normally happens. The issue is, as you have condensate and naphtha demand going down, as you have NGL demand going down on the petchem side, that's going to push some of this product back into the gasoline pool. So we will see this bounce fairly quickly, but again, not going to new all-time highs, just moving back closer to where we were in 2021. When you look at the demand front, you can see that it bounced. Now, one of the things that we've, even when the you had the EIA saying that we were at about 8.3 million barrels a day of gasoline demand, we still had us at about 8.6, 8.7. So where we are right now at about 8.8 is a little bit above where we think we are. Obviously, the delta is being driven based on what is happening in Florida and in the Carolinas. So as that normalizes, we will see this come closer to our level. We will see that drop because A lot of the demand is pulled forward. People fill up. They get gasoline for their generators, gasoline for their cars, making sure that things are juiced and ready to go in case they get hit and they have to escape, or there just isn't gasoline available. Then as that normalizes, again, at that 8.6 million, 8.7 million barrel a day is where we think we're going to live, which is still well below what is normal. A lot of that being driven based on prices are still elevated versus previous years, and then the economic impacts continue to hit hard. Now, as you can see here on just the mobility side, the workplace is fairly flat, but look at it. Workplace is still 20% below normal. That is a real number when you look at people not driving to the office midweek. And that is where we see a lot of that delta, because people are still active on the weekends. They're doing family trips. Now we're in fall festival season, Oktoberfest. We're in apple picking and other types of fall activities. So we will see a lot of movement on the weekends. It's just during the week we are not seeing the same levels. And then when you look at retail recreation trending down, again, people are just not spending the same way, and that is resulting in less activity. So when you look at propane, propylene, the shutdown and cut in runs is putting more product into the market. So now we're right back to the 5-year average. And when you look at the build, there was a build of 1.64 million. That's now 0.2 million above the 5-year average. So exports are still very strong, but you're starting to see those builds because petchems are just not active because of run cuts, because of the demand issues that continue to reverberate through the system. And we really don't see that changing in the near term, which is going to put more propane into storage. Jet fuel had a drop of 2.44 million barrels. When you look at demand, you had that nice spike. Again, that movement to the downside was very much over-exaggerated. The movement to the upside, same thing. So we still come down to our average level of that 1.45, 1.55. But we're seeing a little bit more activity on the flying side, where you can see it was fairly tight in terms of the activity. Now we're still below 2019, but things are getting a bit more normal. And that's something that we think is going to play out, where there's still going to be lower lows and lower highs versus 2019, but you can see it's starting to kind of get towards a more steady number. But even though that is happening, we are starting to see some guidance that there's a slowdown. Now, typically, there's always a slowdown for in terms of flying as we get into this period, but it's a little bit more than normal. So commercial passenger flight jet fuel demand, you can see that the demand is starting to come back down. International flights, domestic flights starting to roll over a bit. But when you look at it on the 12 weeks ahead, passenger flight schedules for the 12 weeks ahead is 2.71% lower than it was last week. The number of passenger flights over the week of September 13th climbed slightly, but now you're starting to see that bigger drop. There's always a drop. The 2.71% is slightly larger than normal, and it's typically because you're starting to see a little bit of a slowdown in ticket sales, and that is cutting some of those. So again, even though we see TSA passenger throughput elevated, we do see some downside in terms of the highs, not so much the lows. I think the lows we're not going to crash through. It's just, I think the high, so essentially the volatility is just going to tighten a touch in terms of those highs will come down a bit. And it's just semantics, because it's not a huge number, but it's just something where that activity is starting to diminish slightly. And then when you look at open table data, you can see that things are tightening up just a bit on the global side. When you look at the U.S., things are a bit lower. Germany is obviously a bit more elevated as we come into Oktoberfest, but again, the U.S. is still either slightly below or right at normal, and we see that kind of maintaining. So we're seeing a fairly normal activity during the seasonal slowdown. The problem is it's moving down on a seasonal basis, but it was already lower. So even though we're moving down on a seasonally normal level, it's just at a reduced number because of economic pressure, because of a lot of these issues. So that's going to, again, keep that demand side fairly weak, and that's going to hit on, again, oil consumption, because you just don't need as much movement. So that's what we have for you on that front. In the next segment, we're going to go deeper into what is happening with Russia, some of the different shifts, and how are things moving on the physical front, especially as China has moved to increase their imports into the market.